Hey guys, it's your two-letter tutor here today, and we're going to be discussing liquidity. So I think to understand liquidity of markets, it's a very important thing to understand the liquidity of a single person or company. So today we're going to start off with a thought experiment, and we're going to do a little bit of math to kind of go over what liquidity is, how it can affect you financially, and how it can affect the market financially once we get onto abstracting and generalizing the concepts that we learn. I think the easiest way is to start off with a balance sheet. On the left side of this balance sheet, we have someone's assets. An asset is something that you own that adds value to your net value. And on the right side, we have liabilities. Liabilities is anything that takes away from your net value. This is just in the sense of equity. We'll go over in later episodes how assets and liabilities have different meanings when speaking about cash flow. So, providing this is a normal American person, we have some assets, maybe in the form of a $10,000 car, a $150,000 house, maybe $5,000 in cash, and let's just say another $5,000 in bonds. So in total, this person has $170,000 in assets. It would be great if we only had assets in our life, but we also have some liabilities. Let's just say out of the $10,000 that his car is currently worth, that he owes $5,000 on it to the dealership. And let's say that out of the current $150,000 that his house is worth, he owes $100,000 to the bank. Now let's just say the person we're examining also likes to spend a little bit more than they should and also has $10,000 in credit card debt. So in total, we have $115,000 in liabilities. What this means is that when we take our assets in the left column and our liabilities in the right column, and we find the difference being $55,000, that is our net value. So currently, our person has more assets than they do liabilities. And if a random payment of less than $5,000 comes around, well, the person can pay it off because they have cash on hand. That cash can be used readily because it is available and does not need any extra processes to be usable. On the other hand, let's say that a $10,000 charge comes up. What is our person to do? He clearly is worth more than $10,000. He has a $55,000 net value, but he only has $5,000 in cash. The other $5,000 of semi-liquid assets he has available are bonds. The reason they are semi-liquid is because the market for bonds is large enough to where you can probably find a decent buyer to pay for almost full price for your bonds in a reasonable amount of time. So, if the bill is due in one day, you might take a loss trying to sell the bonds as quickly as possible. Maybe sell them for $3,000. But if the payment is coming up in a month or two, you could probably get almost around full price. Let's just say $48,000. This kind of situation describes liquidity. The cash he has on hand is very liquid, but the bonds, on the other hand, are semi-liquid. This means out of the $55,000 of net value that he has, only around $10,000 is truly liquid and available to use at any time he needs. The real problem comes if, let's just say, a $30,000 payment comes up. What is he to do? He only has $10,000 in liquid and semi-liquid assets. The only way to fund this would to either be sell his house for the equity that it's worth, meaning sell his house for the difference between what he owes and what it's worth, which currently is $50,000, enough to cover the costs, or he has to take out a loan, which would solve his liquidity problem, but also adds an item to the liabilities column, decreasing his overall net value. So this is the true problem of liquidity. If your assets are not able to be used, you have to borrow money from someone else. And usually this other person that is lending you money is lending it to you at a cost. So truly, illiquidity puts a burden on the spreadsheet by having to take out loans and putting debt burden onto the person or company that has to borrow the loans. Now, market liquidity is very much the same. But when we're talking about markets, we're talking about hundreds of thousands to millions of people. And the loans being issued out are usually by very large organizations, either very large banks or the federal bank itself. When the money supply becomes scarce for any reason, it could be that not enough money was printed, so it's not physically available, or the physical money is being stored somewhere, either in a bank or someone decided that it would be a good idea to keep all of their money in a shoebox underneath their couch, then illiquidity becomes a problem. Because that means if the liquid money of a market is being held somewhere, then the wealth of that market is being held in illiquid assets. So when a depression happens and people need to quickly repay their debts because lenders are scared of defaults due to the weakening market, then suddenly they don't have holds of liquid money to pay back their debts. This makes the market illiquid. Nowadays, it's very easy for the Federal Reserve to either issue bonds or issue more banknotes to help counteract this effect of illiquidity. But this was not always the case. This is actually one of the main reasons why the 1920s market crash happened. It was a credit crunch. People needed to go pay back their loans, but they did not have the money to do so, either because it did not have the net value or because the money that they did have was not in a liquid form. And the Federal Reserve did not have the power to counteract this. This was mostly because the Federal Reserve was tied to a gold standard. The gold standard, very much like in the episodes we covered before, was tied to a metal currency, gold. And this allowed for very stable price points of the US dollar. But it did not allow the Federal Reserve to enact policies to fight illiquidity. So in order to have events like the 1920s Great Depression be easier to fight against, the US went off the gold standard in the 1970s. What this did is it allowed the US government, mainly the Federal Reserve, to pump more money, paper bills, into the economy, either using bonds or physically printing more money to counteract illiquidity. The problem with that is inflation. And I think this graph is going to very well show how bad inflation became once we went off the gold standard. So here's a graph showing the buying power of $1 since the 1700s. This can be used to see what the basic idea of inflation is. Inflation is when a currency starts to be worth less and less over time. Now, many think that inflation is an increase in prices, but this is actually a byproduct of inflation. When a currency is worth less, you have to give out more of it in order to get the same products. So in this graph, I have blocked out all the dates past the 1950s. The buying power of a dollar remains flat and steady, with occasional peaks in times of war. Now, the problem with war is that people use a lot of resources for something that isn't necessarily useful. Think about it. All of the military-grade weaponry, all of the vehicles used, and all of the manpower spent for something that eventually just leads to more death. Now, there are byproducts of war that do increase technological revolution, but mainly those will be found in more efficient ways if they were not used for killing other people, honestly. That being said, we can see there are always peaks when wars would happen, but after the war ended, it would slowly taper back off. And this kind of kept the cost of living and goods stable. In 1780, when America was just first starting, all the way to the early 1900s, a loaf of bread cost the same amount of money. Eggs cost the same amount of money. Transportation and living cost all the same amount of money. So if you got $100, 200 years later, it would still be worth the same amount of money. If I uncover the rest of the graph, we can see that's changed drastically. We can see here that if you had put away $60 right around the time where the gold standard was initiated, being 1971, you would only be able to buy $10 worth of goods in 2019, meaning that the buying power of the dollar has decreased sixfold in only half a century. This, arguably, is the price we pay in order to counteract illiquidity in the market. That being said, though, it's quite startling to see this graph, where for almost 200 years there was no inflation, turn into having almost 600% inflation in the last 50 years. And the question comes whether or not this is sustainable. Sadly, I don't have the answer for that, and most major economists don't really either, because if they did, we wouldn't be in this situation. The only thing that we can do is prepare ourselves and find ways to invest our money so that it doesn't depreciate at the rate of inflation, which markedly, compared to historical averages, is very, very high. Stay tuned for more videos on how to properly invest your money, counteract inflation, and how to understand the basic principles of finance in order to protect your wealth and protect yourself in the upcoming years. Thanks for watching. This has been Odd Explains. Subscribe.